Good news when it comes to rate cuts and policy updates. Let's talk about it on Today in Mortgages. Hey, what's going on, Dreammakers? Welcome back to the show. We're talking about what's real, what's hype, and what you should actually be paying attention to out there in the world of mortgage and real estate news. Rich, big day here.
Yeah.
We're recording this on Wednesday, so there was a Fed meeting today. So, Rich, what did we see out of the Fed today?
Well, we saw Fed Chair Powell announce a 25 basis points cut to the Fed funds rate. We were basically 99.9% sure that was going to happen, and it had already actually been reflected in the pricing for mortgages, at least pricing for the 10-year yield anyway. So, it's been a crazy afternoon, though, since that announcement.
Yeah, tell me more about that, Rich. What have we seen?
Yeah, it's strange with two small words, how much they can have an effect on the perception of this cut and future cuts. Fed Chair Powell said, we are far from a decision to cut more in December.
Right. And so up to that point, we had pretty much thought, hey, we will probably have another cut right before the end of the year. But that far from is putting everyone back to square one on guessing what that looks like, and also seeing, hey, there's a lot of stuff happening in the economy right now. Government shutdown is not making it any easier. So there's a lot of balls in the air that have to be kind of resolved before, as the Fed always does, wants to be very sure and very certain in the data before they make decisions.
Yeah, he's been super conservative. He doesn't want to suggest that these are, certain cuts that are going to happen because we just don't have the data. They don't have the data to support it, and it's changing all the time. So we've got slower job growth. Even though we don't have the government data, we do have private data, and that's what the private data is suggesting. We've got still elevated inflation. Their target is 2%. We're at 3%, even though it was lower than expected. We're still at 3%. So, we're moving forward in the right direction. It just stinks that we gave it all up today, because now investors are like, whoa, we're not going to see a cut in December. I mean, just 7 hours ago, there was an 88% chance of a cut in December. Now, if you look at it, it's 50-50. So that's Now investors are kind of flipping out. We saw the Dow drop. We saw pricing get worse for mortgage interest rates. So, just because we cut a Fed fund rate doesn't mean our mortgage rates go down.
Yeah, Rich, we saw that, time and again, it seems like over the last year, when we do finally get those cuts, it kind of comes paired with some other news that offsets it. So no fun. And we are seeing things happen in the economy. Obviously, there was big layoffs from Amazon last year, which is opposite of what you would expect going into the holiday season. So some skittishness there in the economy, and all those things kind of compound to make it a little bit more nerve-wracking to get out there in the housing market right now. But we have some good things we're going to talk about today as policy-wise. That's the article you sent me today from Housing Wire. It says LLPA fees under review signals relief for borrowers. So, Rich, who's Bill Pulte and what are LLPAs, just for in case somebody's not familiar?
Yeah, Bill Pulte is the FHFA director, but also he's Pulte Homes. So he's in the government now running the FHFA, and he has a pretty good understanding of what interest rates do for the housing market. So he's come in and suggested that we can make some pretty quick changes by changing loan level price adjustments. And for people that don't understand what that is, those are just risk hits at certain FICOs, credit scores, and at certain loan to values. There's big risk hits on those. If he chose to cut them down, we could see an improvement right away in rates of 1/8% in actual interest rate. If he decided to cut out, some bigger, actually eliminate some of them, we could see even better improvement without the changes in the, with the Fed funds rate and all of that stuff. Those are immediate change in price, because the FHFA they've added a lot in 2023 of these hits and changed them and moved them around. And, they really are affecting interest rates.
Yeah, Rich. And the people that are affected most by that, like you said, are the ones that have those risks in their kind of credit profile and may already have a harder time getting approved, having the right funds to get into the market. Am I reading that right?
Sure. Yeah. I'm definitely going to help people on the lower FICO area for sure. But it also helps people with high FICOs with lower down payments if the loan level price adjustments were cut down or eliminated, because they're still, like, if you borrow 95% loan to value, so you're putting 5% down, you've got a risk hit of 1.5 or more. So you get rid of 1.5. A point is basically an eighth in interest rate. So you're talking about a pretty good improvement in rate.
Yeah, and that helps people afford that monthly payment because it brings it down and allows them to qualify for more. So that's really good news. Rich, tell me about the specifics here, what the support looks like for this moving forward. What's the reality on the ground? Is this something that's going to happen?
I don't know. Bill Pulte is new to us, so we don't know. We do know he comes from the industry. I doubt, though, that he'll be able to do much, and I hope he does. But they're trying. They're suggesting, again, the FHFA director and the administration, to take Fannie and Freddie out of conservatorship. And what you're essentially doing by cutting those loan level price adjustments out is giving up profit for the agencies. So it's this catch 22. They need the profit to move them out of conservative, government owned. They need that money to be able to move it, but yet they're talking about, but we're going to cut out some profits so that we can do more loans. So they kind of fight against each other. So we'll see whether they're going to be able to move the agencies, Fannie, Freddie, out of government holdings. I just don't know how that's going to go down, but I would definitely love for him to cut some of these loan level price adjustments. I don't know what side's going to win there. And they're both on the same side. I just don't know which way they're going to be able to go. I don't think they'll be able to go both ways.
Yeah, two solutions trying to come at this from a different angle that kind of pull apart from each other. So, Rich, good word there. Well, we are keeping our ear to the ground on this and making sure that we'll continue to follow the news. One of the things we also want to continue to have our ear to the ground on is how you guys are feeling out there. So we've created a new loan officer survey that you can go to our website todayinmortgages.com and take for free. And it's going to give you a report on where you stand in the industry compared to your peers based on price, comp, technology, support, and more so that you can make the best decisions for your career. It's a great free survey that gives you a lot of great information on the back end. So go take that survey. It's at todayinmortgages.com or click the link in the description below. Rich, as we look to this and other policy adjustments, and we kind of come to the end of the year, we had big announcements from the Fed today. What's on your mind as we kind of take all this information in?
I'm still in the same place. I'm still very positive about the direction that we're going. We're just not taking giant steps. We're taking baby steps, and it's happening, but it's consistent. It's consistently more normal, and that is a place you can operate in.
We'll be paying attention to all those things, and we are always trying to make you guys more smart out there. If you're interested in getting more information like this and want to work with the best network in mortgages and get pro tips and training from people like Rich Jefferson, click that grow link below. We'll tell you all about the network funding and how you can grow your career going into 2026. Rich, any final words today?
That's it, man. Just anybody that watches this, our audience, if you're in the mortgage business, stay positive. Don't forget, still good things are happening. And if you're a referral partner, a real estate agent, again, great job. You toughed out the last 3 years and things are looking up for you too. So I just feel positive and I just want to keep moving forward like this.
All right. You heard it here first. Sunshine and rainbows in 2026. We're all crossing our fingers. Thanks so much, Rich. Thanks everyone out there for watching and listening. Wherever you are, we appreciate you. We'll see you next time on Today in Mortgages. Today in Mortgages is produced by Network Funding LP, which is an equal housing lender, NMLS 2297. The content of this program is meant to be a commentary on mortgage and real estate news, and any discussion of rates and or products should not be taken as an individual mortgage or home buying advice or pricing estimates. And any commentary on this show should not be considered a promise to make a loan. All applicants for a loan must qualify, and you should consult a professional regarding your individual loan scenarios for your financial situation. Visit our website at nflp.com/licenses for all state licensing and other legal information.